Silver just dropped hard, from 91 down to 85, $6 erased in a single session. And if you were watching that candle form in real time, you probably felt it, that tightening in your chest, that voice saying, that's it, the rally is over, but before you make a decision based on fear, you need to step back. Because when you zoom out and look at the mechanics behind what just happened, the story changes completely. This wasn't random, this wasn't fundamentals collapsing, and this definitely wasn't demand disappearing overnight. Something else is happening beneath the surface, and once you understand it, these crashes start looking very different. The pattern nobody is talking about. Let's start with something simple. 3 months, 3 sharp end-of-month drops, 3 recoveries shortly after. That's not coincidence, that's structure. At the end of every month, futures contracts approach expiration. Traders holding those contracts must make a choice. Roll the contract forward or stand for delivery and request real physical silver. This is where pressure builds. Because futures markets are mostly paper promises, but when expiration approaches, those promises must either be extended or fulfilled. And here's what's changed recently. More traders are choosing delivery. That's the stress point. When too many participants want physical metal at the same time, the exchange has to match buyers with sellers who can actually deliver real silver. If that matching becomes difficult, volatility spikes. Now add this to the equation. The exchange halt. During this recent sell-off, the major metals exchange halted trading mid-session. Gold, silver, copper, everything paused. The official explanation? Technical issues? Maybe, but the timing is what raises eyebrows. We were entering a major notice period. Open interest in silver contracts was elevated. Delivery month was approaching. Pressure was building. And right in that window, trading stops. Historically, full-scale metals halts during expiration week are rare. When they happen near major delivery dates, it usually means order flow imbalances became significant enough to disrupt normal matching. That doesn't mean conspiracy, it means stress. When exchanges intervened, their mandate is simple: maintain orderly markets. If volatility accelerates beyond control, they slow things down. But here's the key. When trading resumes after a pause, the order book is different. Impatient buyers may have rolled contracts forward. Aggressive sellers may dominate the flow. And price can drop quickly on buying, not because fundamentals changed, but because positioning shifted. That distinction matters. Gold versus silver. The divergence. Here's another important observation. On the same day silver fell sharply, gold recovered strongly. Normally, gold and silver are highly correlated. They move together in macro-driven environments. Inflation expectations, dollar weakness, geopolitical stress, these forces usually lift both metals. But this time, gold bounced, silver lagged. When correlated assets diverge, it usually signals something specific is affecting one market more than the other. Silver's futures positioning and physical delivery cycle are currently tighter relative to its market size than gold's. Silver is smaller, more volatile, and more sensitive to delivery stress. So when expiration pressure builds, silver feels it first. This doesn't imply manipulation, it implies structure. Silver's market is thinner. When positioning shifts rapidly near expiration, price reacts more aggressively. The physical market has not changed. Here's the part that most panic sellers overlook. Price moved, but physical metrics did not suddenly improve. Vault inventories remain lower than they were months ago. Industrial demand hasn't evaporated. Asian premiums haven't collapsed. In fact, in certain global markets, physical silver continues trading at elevated premiums compared to international spot benchmarks. That means buyers are still paying up for real metal. If demand had truly disappeared, premiums would collapse first. They haven't, and that tells you something important. The price drop happened on paper markets. The real-world supply situation did not suddenly reverse. Why end-of-month drops keep happening? Think about incentives. At expiration, if prices are rising rapidly, more contract holders may choose delivery. Rising prices increase the appeal of securing physical supply. But if price cools off sharply just before notice day, urgency fades. Some participants roll forward instead of standing for delivery. From a system stability standpoint, slowing velocity reduces stress, and that's the word that matters here. Velocity. Markets can tolerate rising prices. What they struggle with is rapid acceleration during delivery windows. When silver surges too quickly near expiration, the matching process between paper contracts and physical supply becomes more difficult. Cooling off price into expiration reduces immediate pressure, and that's exactly what we've seen repeatedly. December, sharp drop near month end. January, same structure. February, another late month pullback, each followed by recovery. When something repeats at the same structural point in the calendar, you don't ignore it. You study it. The moving average that keeps climbing. Now let's zoom out technically. Silver's medium-term moving averages have continued trending upward for months. Every dip has been absorbed. Every sharp sell-off has eventually been bought. That doesn't mean price can't correct further, but it does mean the broader structure remains intact until proven otherwise. Trends don't break because of one volatile session. They break when lower highs form consistently, support fails repeatedly, physical demand deteriorates. We have not seen that yet. The psychology of shakeouts. There's another layer here, psychology. After repeated sharp pullbacks that later recover, market participants adapt. The first crash shocks people. The second crash confuses them. By the third crash, experienced holders recognize the pattern, and what happens? Selling pressure weakens. Notice something important. Each recent pullback has been shallower than the prior extreme. Deep panic bottoms require weak hands, but after multiple shakeouts, many of the weak hands are already gone. That's why later corrections often shrink in magnitude. It doesn't guarantee immediate upside, but it signals structural strengthening. The bigger monetary context, major financial institutions have begun publishing long-term scenario analyses projecting significantly higher equilibrium gold prices under certain monetary conditions. If gold reprices higher over time, the gold to silver ratio mathematically pulls silver upward as well. Silver doesn't need to outperform gold to rise dramatically. It only needs to maintain its relative historical relationship. That broader macro environment has not changed because of a $6 move. Debt levels remain elevated globally. Central banks continue managing currency stability challenges. Industrial electrification demand for silver remains structurally supported. Short-term volatility doesn't erase macro drivers. What actually matters? Now, instead of asking, why did silver crash? Ask, did physical inventories suddenly surge? Did industrial demand collapse overnight? Did global monetary policy reverse in 24 hours? The answer is no. What changed was positioning near expiration. That's a tactical shift, not a structural breakdown. The real risk factors. Let's be balanced. There are risks, margin hikes. If volatility remains elevated, exchanges can increase margin requirements. That forces leveraged traders to liquidate. Support failure if silver loses key technical levels and fails to recover, the correction could deepen. Delivery month surprises if actual delivery demand comes in lighter than expected. Urgency could temporarily cool. Those are legitimate risks, but none of them equate to the end of a long-term bull structure. What's smart money? Watch as experienced commodity traders don't panic on expiration volatility. They watch DOT, inventory flows, delivery statistics. Premiums in physical markets, open interest trends price is the headline. Flow data is the truth. Right now, flow data has not flipped bearish. The bigger question. Here's the real question you should be asking. If silver were truly breaking down structurally, would these sell-offs keep recovering month after month? Or would they cascade lower and stay there? So far, they haven't stayed down. That matters. Where we go from. Here March becomes critical. If support holds and silver stabilizes, the pattern of end-month pressure followed by early-month recovery continues. If resistance near prior highs breaks with conviction, momentum traders re-enter aggressively. But if support fails decisively and vault inflows surge, then the thesis needs reevaluation. That's how disciplined analysis works. Not emotion, not panic, not blind optimism. Data first, always. Not all futures months are equal. Some months carry light volume and minimal delivery. Not all futures months are equal. Some months carry light volume and minimal delivery. Others are heavy-hitting expiration cycles where real metal moves. March is one of the big ones. When a major delivery month arrives, open interest matters. If a large number of contracts remain open into notice day, it signals potential delivery demand. Now think about the timing. We just had elevated open interest, a sharp end-of-month sell-off, an exchange halt during expiration pressure. That combination tells you the system was managing stress. The key question now becomes simple. How many contract holders actually stand for delivery? Because this is where theory becomes reality. Scenario 1, delivery demand. Surges. Let's say March delivery numbers come in strong. What does that mean? It means more market participants are choosing physical silver instead of rolling contracts forward. When that happens, registered inventories decline. And here's where it gets important. Silver is not an unlimited asset inside vault systems. Registered inventory, the metal actually available for delivery, is only a fraction of total global supply. If strong delivery demand continues month after month, vault levels trend lower, and falling registered inventory creates psychological pressure. Because once inventories fall below certain thresholds, market participants start asking uncomfortable questions. Is there enough metal to meet obligations? Will delivery timelines stretch? Will premiums rise further? You don't need a default to create price acceleration. You just need tightening, and tightening supply during rising demand creates upward pressure. Scenario 2, delivery. Disappoints. Now, let's be balanced. What if March delivery demand is lighter than expected? What if many traders roll forward? Short term, that could cool urgency. Price might consolidate. Volatility might fade. But here's what it does not fix. Industrial demand, long-term monetary pressures, global debt expansion, currency instability trends. A quiet month delays acceleration. It doesn't reverse structural conditions. And here's the bigger point. Even if 1 month cools off, repeated inventory declines over multiple months create a cumulative effect. Silver doesn't need a dramatic event, it needs persistence. The margin. Hike risk. There's something else we have to talk about. Margin requirements. When silver moves quickly, exchanges can raise margin requirements. That forces leveraged traders to post more collateral or liquidate. We've seen this before. Margin hikes can cause violent short-term drops. But here's the reality. Margin hikes don't create new silver. They only shake out leveraged speculation. Physical buyers aren't forced to sell because of margin changes. So if margin hikes happen again, you could see another 5 to 10% dip. But historically, those dips get absorbed if physical demand remains steady. Margin hikes are speed bumps, not structural breakdowns, the level that changes everything. There's one price level everyone is watching. The breakout zone above recent highs. Round numbers matter psychologically. When silver approaches triple-digit territory, something changes. It stops being a niche market discussion. It becomes mainstream conversation. Financial media notices. Retail investors start paying attention. Momentum funds rotate capital. And that's when volatility increases. Because new buyers entering a tightening market amplify moves. The difference between $85 silver and $100 silver isn't just $15, it's visibility. Once a commodity becomes headline news, inflows accelerate. And in a market with limited registered supply, accelerated inflows create exponential price behavior. Velocity versus direction. This is one of the most misunderstood aspects of this cycle. Large institutions may tolerate rising prices. What they cannot tolerate is uncontrolled velocity. A slow grind upward, manageable. A vertical spike during delivery stress, problematic. So what do we keep seeing? Run, cool down. Run, cool down. It's not about preventing higher prices, it's about controlling speed. But here's the flaw in that approach. Each cool down sets a higher floor. December bottom, January bottom, February bottom. Higher lows. When floors keep rising, suppression becomes less effective over time. Eventually, cooling attempts fail, and when they fail, the breakout is more violent because pressure has been building underneath. The gold to silver ratio effect lets zoom out macro. When gold strengthens in long-term cycles, silver eventually follows, often with higher percentage gains. Silver historically lags during early monetary phases and accelerates later. If gold continues trending upward due to currency debasement concerns and global monetary expansion, silver benefits mathematically through ratio compression. The ratio doesn't need to return to historic extremes to justify significantly higher silver prices. It only needs to normalize slightly, and even minor ratio shifts can move silver dramatically because of its smaller market size. Industrial demand is the silent driver. Most people focus on silver as a monetary metal. But silver is also industrial, to electronics, solar panels, electric vehicles, medical applications. Industrial consumption doesn't vanish because futures contracts sell off for a day. In fact, lower prices can trigger more procurement activity from manufacturers locking in supply. That creates an interesting paradox. Paper weakness can strengthen physical demand. And if physical demand strengthens while inventories tighten, the next upside wave becomes stronger. The psychology of the third shakeout, here's something behavioral. After repeated fake breakdowns, traders adapt. The first crash creates panic. The second crash creates doubt. The third crash creates skepticism. And skepticism is healthy because experienced participants begin asking, why does this keep recovering? Once enough market participants recognize the pattern, sell-offs lose power. Fewer weak hands remain. That's why recent dips have been shallower. Selling pressure requires sellers. If most of the emotional sellers already exited in prior shakeouts, downside momentum weakens naturally. What would invalidate the bull case? Let's be disciplined. Here's what would change the thesis. Sustained inventory increases. Multiple failed rebounds with lower highs. Collapsing physical premiums globally. Industrial demand contraction confirmed by real data. If those happen together, the structure shifts. But so far, we haven't seen that alignment. Instead, we've seen inventory drift lower, higher lows forming, strong physical premiums, recurring recoveries after volatility. That's not breakdown behavior, that's coiling behavior. Why March could be the inflection point. March matters. Because it's a major delivery month. It follows 3 end-of-month shakeouts. It comes after visible exchange intervention. It tests whether higher floors hold. If March stabilizes and pushes above recent highs, the narrative changes, because then the pattern becomes undeniable. Late-month sell-offs lose credibility, short sellers lose confidence, momentum traders step back in. And once momentum aligns with tightening supply, price doesn't drift higher. It accelerates. The bigger monetary backdrop, we can't ignore the macro environment. Global debt continues expanding. Sovereign deficits remain elevated. Central banks face structural pressure. In such an environment, hard assets gain relevance. Silver sits at the intersection of monetary insurance and industrial necessity. That dual identity makes it uniquely volatile, but also uniquely positioned during transitional monetary periods. The recent crash didn't change that macro backdrop. It only changed short-term positioning. The bottom line, here's what matters most. A $6 drop feels dramatic in the moment, but trends are built over months, not hours. If physical supply remains tight, if delivery demand persists, if higher lows continue forming, then this crash becomes just another data point in a rising structure. Not the end, just a shakeout. March will tell us whether velocity control continues working, or whether pressure overwhelms the cooling mechanism. Because eventually, if tightening persists long enough, price breaks through resistance and doesn't look back. And when that happens, it won't feel slow, it will feel sudden. That's how coiled markets resolve, not gradually, all at once.